And for my second video of the day, we are going to charleshughesmith.blogspot.com because he does have good stuff from time to time too. And this was listed on Zero Hedge, but I'm going straight to the source this time, baby. The big reversal. Inflation and higher interest rates are coming our way. Now, in all fairness, they're still not here yet. And they should have been here a while ago. But the Fed is doing this. And again, they're creating all these asset bubbles. Sooner or later, rates must rise. We know that much. This interaction will spark a runaway feedback loop that will smack asset valuations back to pre-bubble, pre-pyramid scheme levels. According to the conventional economic forecast, interest rates will stay near zero essentially forever due to slow growth. And since growth is slow, inflation will also remain neutral. This forecast is little more than an extension of the trends of the past 30 years. A secular decline in interest rates and official inflation, which remains at around 2% or less. As many of us have pointed out over the years, the real rate of inflation is much higher, in the neighborhood of about 7% annually for those exposed to, real world costs. The burrito index. Consumer prices have soared 160% since 2001. Inflation isn't evenly distributed. The protected are fine. The unprotected are impoverished debt serfs. Another one. About those hedonic adjustments to inflation, ignoring the systemic decline in quality, utility, durability, and service. Another one. Be careful what you wish for. Inflation is much higher than advertised. Anyways, these are all sources and stories he's linking. Not from like today or yesterday, but in the past. From 2016 through earlier 2017, as well as even October this year. Apparently, unbeknownst to conventional economists, trends eventually reverse or give way to new trends. As a general rule, whatever fundamentals are pushing the trend, decay or slide into diminishing returns, and new dynamics arise that power a new trend. I've often referred to the S curve as one model of how trends emerge, strengthen, top out, weaken, and then fade. Trends often change suddenly, as in the phase shift model, in which the status quo appears stable until hidden instabilities cause the entire permanent and forever status quo to collapse in a heap. The Bank for International Settlements recently issued a report claiming that demographics will reverse 3 multi-decade global trends. Here's a preface of the case for globally aging populace and a shrinking workforce to reverse the downward trends in inflation and interest rates. New study says aging populations will drive higher interest rates. Bloomberg. Gordon Long and I discussed the demographic and the financial forces that will reverse zero-bound interest rates and low inflation in our latest video program, The Big Reversal. The demographic case is actually a study of labor, capital, and savings. In essence, the authors of the paper are saying that the vast expansion of the global workforce, led by the emergence of China as the world's workshop, is a one-off that is about to reverse as the global baby boom generation retires en masse. They also argue that the equally vast expansion of credit debt that's powered the global expansion in the 21st century is also a one-off, as the monumental debt overhang has a characteristic peculiar to debt. It accrues interest, and as the debt balloons, even low rates of interest add up, weighing on weak growth and soaring entitlement spending. Although and by the way, former Fed Chair Greenspan, a lot in recent times has been talking about that last thing I just said, entitlement spending. That's his biggest thing he harps on as he talks every now and then. Although it is not popular in today's debt-dependent zeitgeist to mention this, debt is not capital, but put another way, savings still matter. And as the older generation of workers retires, they will draw down their savings, a process that will make real capital, as opposed to lines of credit resting on fictitious or phantom collateral, more scarce and thus more costly for those wishing to borrow it. Since it's a given that human labor is being replaced by robots and automation. The author's call for higher wages strikes many as a false hope. If the human labor force is shrinking due to automation, why would wages for the remaining workers rise? One little understood fact helps explain how labor can be scarce even as many jobs are automated. The easily automated work is commoditized and low touch, meaning that the human touch isn't the value proposition in the service, but the value of the high touch services is added by the human presence. Do you really want to go to a swank bistro and place your order or retrieve your food from an automated service kiosk serving automated prepared meals? Isn't the value proposition of the bistro that will have a knowledgeable and experienced service and kitchen staff? Granted, there may be people who will be delighted to be served in cubicles by robots, but since we're social creatures, this will wear thin for those who can afford more than an automated fast food meal. Even the most modest discounting of the hype about AI, artificial intelligence, provides a more granulated understanding that not all work can be commoditized, and indeed, non-tradable work that cannot be commoditized will increase in value precisely because its value isn't created by the process of commoditization. If the labor force shrinks at a rate that's faster than the expansion of automation, wages will rise even as automation replaces human labor. I explain this further in my book on work in the emerging economy, Get a Job, Build a Real Career, and Defy a Bewildering Economy. Gordon and I add the systemic fragility introduced by financialization to the demographic argument. The global, or which really the entire global asset market, stocks, bonds, real estate, and commodities, is at the heart a pyramid scheme in which the rapid, it's funny about these pyramid schemes, I'm talking about, cryptos, pyramid schemes, and he's talking about the old school style. Is at the heart a pyramid scheme in which the rapid expansion of credit drives asset prices higher, and since assets are collateral for additional debt, the higher asset valuations enable a new round of hyper-credit expansion. This pushes asset valuations even higher, which sets the stage for an additional expansion of credit, based, of course, on the astounding rise in the value of the collateral supporting the new debt. Central banks have powered this pyramid scheme by buying bonds and stocks with currency created out of thin air. This chart of the Bank of Japan's astonishing balance sheet is a bit outdated, which I'll show you. The Bank of Japan has purchased so many bonds and ETFs, or stock funds, that it is now a major owner of Japanese stocks and bonds. Look at this. This is insane. This is beyond insane. Where's the real market? Where's the real people buying these things? Does anybody exist? No, I mean, just central banks. In this case, the Japanese central bank. Jiminy Christmas. Look at this. As a crocodile hunter, we used to say, have a look at this. Oh, she's a beaut. No, Steve Irwin, that is not a beaut. Of course, debt isn't just a central bank phenomenon. Corporate and household debt have also soared as well. The global debt overhang is unprecedented. The big overriding balance sheet theme. Too much debt. China is too high on this chart for developing economy, which is the massive amount of debt that they show. My view is that once this tsunami of new debt-based currency hits the real-world economy, inflation will move a lot higher, a lot faster than most pundits believe is possible. Trillions of yen, Chinese yuan, euros, and dollars have flooded into these asset pyramid schemes, if you will. Once the tide washes into real-world goods and services, the inevitable result is inflation. The tectonic forces of demographics meeting the increasingly fragile pyramid scheme of financialized debt-inflated asset bubbles will more than reverse the 30-plus year trends of ever lower inflation and interest rates. This interaction will spark a runaway feedback loop that will smack asset valuations back to pre-bubble, pre-pyramid scheme levels. If you found value in this content, please join me in seeking solutions by becoming a $1 a month patron of my work via patreon.com. And that's for charleshusmith.blogspot.com. Okay? So yeah, I mean, The question, though, it's a serious question. Can they drag this crap along even further? Again, let's go back at the same chart. The Japanese one, Bank of Japan balance sheet. Right? Obviously, this is going up. 2008 happens. Oh my God, up. And now around 2013, my goodness. This is insane. But the European Central Bank's doing it. Our Federal Reserve has been doing it. $4.5 trillion on the balance sheet, etc. Right? And they've been pumping this along for a few years now. So in all fairness, could they push this out to 2020, 2021, 2022? I mean, again, that chart is unbelievable. As long as they're buying all this stuff up and propping everything else up, well, I guess it can continue for a while longer. But again, there's even the minuscule amount of low interest rate. There's interest rate. So if our 20 trillion becomes 40 trillion in the next 8 years on that, and again, the Federal Reserve, we're going to rise another 0.25%. We're going to rise another quarter. Even if they go back down to, okay, let's go back down to like 1%. 1% of 20 trillion and 1% of 40 trillion. It's going to hurt a lot more than 40 trillion, is the point. But can they kick the can? They have been. They certainly have been. That's why I like cryptos. Cryptos, they can do whatever the hell they want, and it lessens how it affects you. Why? Because you'll be sitting on some profit over the next few years. Again, get your Bitcoin, Litecoin, Ethereum, and sit on it. Even if it's a fraction of those, just sit on them. Don't touch them. And then if you want to play the ICO game or some of these ones that are already out there, some of these altcoins that are already out there, get some additional funds for that. Let your stash sit over there. You've seen what they've done this year. Can't wait to see next year as everyone else starts to figure out what's going on and starts to jump into the cryptos. I don't have a hard time believing $20,000 for Bitcoin, $1,000 plus for Ethereum, hundreds of dollars for Litecoin. I have no problem even kind of believing in that. Take care.